market, tea leaves for 2018. This morning, the first trading day, an official business day in 2018 with Motola Abimbola, one of the investment analysts at Afrivest. Let's continue the conversation around those projects and how do we fund them, and if the market actually has something to take away from there. What should the market look for in this very expansive President Buhari's Rail, Road and Power Belt initiative?
Yeah, I think what his speech suggests is that we're going to likely see another fiscal expansion in 2018 because we are now seeing a positive momentum in the oil markets, which is positive for fiscal balance, and the government still intends to do a lot of deficit funding in order to deliver on these projects. So it's going to be an expansionary fiscal year in 2018 and possibly 2019 as well because of the entire electoral cycles and the need to deliver on these projects before the election starts properly. However, like I mentioned before, there are still some very important reforms for the government to do. All the infrastructure being delivered, particularly on the rail and the road sides, they are still entirely deficit funded by the government, right? And so there is still a need for the government to create an enabling environment to allow for private capital to be able to invest in all these projects.
Whichever deficit you're talking about, it's all about debt.
Indeed.
More debt. So
Indeed.
will Nigeria's debt burden worsen in 2018?
Likely it's going to... there is a possibility that might happen, because of the urgency the federal government is embarking, because of the urgency in delivering on infrastructural projects before the election cycle starts. However, because we are seeing a stable increase in oil prices, we have seen FARC allocation to the different subnationals as well as the federal government's increase in recent time. At the beginning of the year, FARC distribution to the 3 tiers of government was around 400 to 500 billion naira per month. Right now, we're above 600 billion naira per month. So that's very positive and likely going to reduce the need or the urgency to embark on deficit financing for the fiscal year.
Well, we all know where FARC money goes. It goes basically into salaries and wages, right?
Indeed.
Okay, yeah, so we need money for infrastructure, and the president spoke about roads and rail that cost a mountain of dollars to build. So, so we're going to borrow money. And the DMO is talking about another $2.5 billion Eurobond in 2018. Yeah,
indeed. And that is also in line with the borrowing plan that they already guided towards at the tail end of last year. And for the DMO, the Eurobond that they will be doing in 2018 will be directed towards two major needs. The first one is to finance the government deficits, and the second one is to further reduce the high rates of borrowing in the local markets by trying to refinance existing treasury bills. Last year, the DMO, rather the Ministry of Finance, they did mention that there is a plan to substitute maturing treasury bills, or rather to refinance maturing treasury bills with about $3 billion of external borrowing.
Okay.
We've done $3 billion already in 2017.
Yeah, we did $500 million.
$5.5 billion, and the remainder, which is $2.5 billion, is expected to be done in 2018.
And that goes into refinancing the treasury?
Refinancing treasury bills as well as financing the government deficit as well.
So we still need a lot of money to meet those infrastructure projects.
Indeed, we do.
But again, what's the new horizons for fixed income here within this space? Do you think the government will be able to lean on the pension industry? Will it be able to lean more on DFIs to ramp up on this critical infrastructure spending?
Yeah, it's been an interesting, rather 2017 was an interesting year for the fixed income markets. At the beginning of the year, we were seeing average bond yield on the government bond rather, at about 16% or over that. But towards the end of the year, the average bond yield was less than 14%. So we have seen over 200 basis points moderation, in yields in the fixed income markets. And that rally in the fixed income markets is being driven by 3 major factors. Number one is the federal government's fiscal plan to refinance higher domestic borrowing with much more cheaper funding sources in the global markets, also driven by the CBN's OMO strategy. In December, the CBN reduced, they stopped issuing OMO bills for about a week or two, and that effectively guided down rates in the fixed income markets. And the third factor is the fact that the market is expecting easing of monetary policy in 2018. So all these factors, they have led to a downward shift in the yield curve, which is favorable to the government as well because it means they have to borrow at a much more cheaper cost, you know, in 2018. And we still expect that to continue.
We don't see any negative yield return on Nigerian assets anytime soon. Am I correct?
Could you come again?
Yeah. Is it likely that we'll have a negative yield?
Negative yield?
Yes.
No, definitely no.
Not anytime soon.
Definitely no.
Not anytime soon.
Yeah.
So despite the outlook on inflation and the rate position of the central bank?
For inflation, in 2017, inflation disappointed a bit. We started the year at about 18.7%, and the consensus estimates, you know, by analysts was that by the end of the year we should be at around 15% or thereabouts because of the high base effects coming from 2015. However, if you notice, inflation moderated to about 16.1% in June 2016, and it has been very sticky at that level up to November. November was around 15.9%. So between June and November, we only saw like a 20 basis point moderation in inflation rates, you know, since the beginning of, since in the second half of the year, essentially. And that disappointing inflation figure, you know, there has been many theses regarding the factors driving it. One school of thoughts, you know, says that because we are seeing, because we have seen a depreciation, you know, in the naira, then that means that neighboring countries to Nigeria, particularly in the Sahel region, you know, have increased their demand for locally produced food items in Nigeria. So, you know, that has driven exportation and also led to increase in the domestic food prices. And that theory says that perhaps because of the restrictions we are seeing in the FX market for some important food imports like rice, like palm oil, etc. So that's it driving up, you know, prices for food items. So 2017, we saw food prices, you know, having a very high impact on inflation. But for 2018, if we do not see an official increase in petroleum products prices, or we do not see an increase in power tariff, you know, as we expect, you know, then that means that we should probably see further moderation in headline inflation in 2018. However, because of the, you know, political cycles and all that, there will likely be much more spending towards the fourth and third quarter of the year. So that could probably put much more pressure on prices in the economy. But if you look at consensus opinion, it still favors a downward moderation in inflation rates, probably by another 200 to 300 basis points before the year runs out. So on that basis of an expectation of, you know, lower inflation rates, we still expect the yields in the fixed income market to continue to moderate. And for us, we've been telling investors to position at the longer end of the curve, you know, lock in the durations.